The live intraday stock price for Genius Group Ltd, trading under the ticker GNS, is 0.93 USD, reflecting a significant move upward of plus 0.064 or 7.45% on the day so far. This kind of volatility, particularly on an upswing, is exactly what you expect from a microcap stock on the NYSE American, yet the current spike isn't just about a good trading day. The immediate, unexpected insight here is that this single-day gain is almost certainly a direct reaction to a major legal maneuver. The company has just filed a federal securities class action lawsuit against two colossal market-making firms, Citadel Securities LLC and Virtu Americas LLC, alleging a multi-year scheme of market manipulation, including spoofing and naked short selling. That is the kind of headline that can temporarily flip the script on a stock, transforming the narrative from one focused purely on financial fundamentals and operating losses to one centered on shareholder activism and a high-stakes legal fight against alleged predatory trading practices. For a stock whose public perception is often anchored to its low price, relatively small market capitalization of about $75 million, and its recent history of share dilution, this legal action dramatically shifts the expectation versus reality dynamic, injecting a burst of defiant optimism that retail investors, who often feel disenfranchised by systemic trading practices, are eagerly embracing. The reality is, this is not a traditional earnings beat or a product launch driving the price. It's a litigation catalyst, and that creates an entirely different risk and reward profile for current and prospective shareholders. The common default expectation when looking at Genius Group is to view it as a struggling small-cap education technology company with an ambitious, almost sprawling business model that has consistently posted losses, evidenced by a trailing 12-month earnings per share of negative $0.33 and negative revenue trends in recent quarters. Its volatility, with a 52-week range stretching from a low of $0.21 to a high of nearly $2, typically signals a high-risk speculative name. However, the contrarian, deeper take that the current price action forces us to consider is that the stock's performance over the last few years may have been distorted by the very market forces the company is now suing over. This suit, which seeks at least $250 million in damages and claims manipulative trading occurred on 98% of all trading days between April 2022 and May 2025, forces us to reevaluate whether the share price truly reflected the company's underlying value or was a function of artificial downward pressure. The current trading volume is elevated, a natural reaction to this high-profile news, and the short interest, last reported around 5.58% of the float, is suddenly in the spotlight. While that percentage may not sound excessively high compared to some other popular short targets, the context of the lawsuit, alleging naked short selling and systematic price suppression, turns every tick up into a possible sign of short covering or a new influx of buyers betting on the outcome of the litigation. The expectation of continued languishing is being directly challenged by the reality of a corporate action designed specifically to address this perceived manipulation and protect shareholder value. This is a crucial distinction for any individual brokerage account holder considering a position, whether they use the simplicity of an invest online platform like Robinhood or the more robust research of Fidelity Investments or Interactive Brokers. The nature of the stock shifts from a pure fundamental play to a hybrid of fundamental and legal arbitration speculation. Expanding into the technical and recent movement of the stock, the bounce off recent lows is significant. Over the last 7 days, even before the lawsuit announcement, the stock had moved up by over 16%. This suggests a degree of accumulation or positive movement was already underway, perhaps in anticipation of this filing or related corporate actions. The volume surge accompanying today's price jump confirms the market is taking this lawsuit seriously. When a micro-cap company, particularly one with a small institutional ownership footprint, footprint, around 1.74% of shares held by institutions, takes on market-making giants, it galvanizes the retail trading community. The CEO, Roger James Hamilton, has been very vocal about protecting shareholders, even establishing a Bitcoin loyalty payment program with a November 28, 2025 record date for shareholders who transfer their shares via the Direct Registration System, DRS. This is a clear tactic designed to reduce the number of shares easily available for short selling through traditional brokerage systems, another deliberate attempt to counteract alleged market abuses. Retail traders, whether they are using Schwab Intelligent Portfolios for passive management or actively trading on the SoFi Invest platform, are acutely aware of these structural issues, and this corporate defiance acts as a powerful sentiment driver. The fact that the CEO and other insiders have been actively buying shares in the open market, reported as recently as October 2025, further aligns management interests with shareholders and lends credibility to their claims of manipulation. Looking at the financial health and business model, Genius Group Ltd is an AI-powered education group that focuses on entrepreneurial learning. They utilize AI-powered tools and offer education and acceleration solutions through a Genius City model and an online digital marketplace. They operate through two segments, education and campus, the latter including resorts and co-working cafes for entrepreneurs. Their brands include Genius U and Genius Group.ai. In the last reported half-year ending June 30, 2025, the company missed analyst estimates, reporting an EPS of negative $0.36 against an estimate of negative $0.08, and revenue of $2.72 million against an estimate of $3.79 million. The long-term financial picture shows a company burning cash, with negative net income and cash flow from operations and significant shareholder dilution over the past year. This is the reality that the market has conventionally priced in. However, the expectation being built now is that if the lawsuit holds merit, and if the company's efforts to control the share float through buybacks and the Bitcoin loyalty payment program are successful, the stock price should, in theory, revert closer to a fair value unencumbered by manipulation. This is where the tension lies. Are you investing in the financial health of the educational business, or are you effectively placing a high-risk bet on a favorable outcome in complex multi-million-dollar federal litigation? This question is something every investor, even those relying on automated investment help like an intelligent portfolio, needs to internalize. The fundamental reality of the operating losses is still there, but the market's expectation of how much that should punish the stock price is now being dramatically recalibrated by the legal news. The future outlook for Genius Group is bifurcated. On the legal front, a positive outcome in the lawsuit, even a settlement, could provide a significant one-time cash infusion of potentially hundreds of millions of dollars, which for a company with a market cap below $100 million would be transformational. It would dramatically change the balance sheet, provide non-dilutive capital for growth, and potentially silence the persistent narrative of a stock unfairly punished. The upcoming November 28, 2025 record date for the Bitcoin loyalty payment is another short-term catalyst designed to encourage direct registration of shares, DRS, a move that activist retail investors view as a way to expose and reduce the pool of shares available for shorting, which could pressure the stock price upward through reduced supply. On the operational side, the company has announced plans to expand its Genius City concept and has stated a financial goal of achieving $10 million to $13 million in revenue and $0.2 million to $1 million in positive EBITDA for the full year 2025. They are also aggressively pursuing AI integration and Bitcoin-focused educational offerings, tapping into two of the biggest speculative trends in the market. The success of their new projects, such as the recently announced partnership for Genius School and Genius City in Bali, will be critical for long-term viability. Risks, however, are substantial. The lawsuit is a lengthy, expensive, and uncertain process. The stock is highly illiquid and susceptible to massive swings, and the company still needs to prove it can reach consistent profitability and positive cash flow. This current price movement, though positive, is purely sentiment-driven, an echo chamber reacting to the legal action and not yet a reflection of a fundamental shift in the core business. If you are an investor looking at taking on this speculative risk, whether through a traditional individual brokerage or a zero-commission platform like Robinhood, you need to understand that the current positive momentum is built on the expectation of legal victory and not necessarily operational excellence. This stock is far from the stability sought by conservative investors using Fidelity ETFs or Fidelity mutual funds, and is squarely in the territory of high-risk, high-reward self-investing. Comment below on which other small-cap company you believe has been unfairly targeted by alleged market manipulation in the last year. In summary,